Hey, what's up guys? Today we're gonna talk about trailing stop losses, or this is a video on giving you an idea on how to use trailing stop losses, or how I personally see them, or how I've seen in the past, or through my experience on what price might do. How do we avoid getting stopped out really early, and choose between an aggressive trailing stop loss, let's say put an aggressive, or a conservative, or let's make this letter C. Oops. Yeah, we have an aggressive and a conservative stop loss. Now again, obviously this is in basic explanation. Aggressive meaning we're trailing our stop aggressively when price is moving down to the downside, for example, to the downside. Now in conservative, trailing stops is vice versa of that. We are trailing either on structural shifts or larger time frame structural moves. So let's go first on a aggressive trailing stop. Now let's say we have a POI over here. We're looking for buy, so let's move it below POI here. We see price moving down. This is the overall structure. Price taps into it, POI. Now we look for confirmations. Now what's our confirmation? Personally, I use Wyckoff. We see a spring, then a breaks of structure, then we ride the retest. Now let's just mark this up as orange, as representing the lower time frame. Now basically on within this blue lines over here, this is the blue line. Let's just say the blue line is the 30-minute and the orange line is the 1 minute. Now obviously on lower time frames you could see price doing this. Now we see a structural shift breaking previous lower highs, higher lows. Then we see a push to the downside, a downtrend on specifically on that lower time frame, because again overall the structure is on a downtrend, and we're expecting price to bounce off from this POI. Now what you can do as a trader, because again we can use trailing stops as a advantage for us, or as a tool for us, since if we believe in or if we use smart money concepts, we have huge RRs. Huge RRs, that's the term. Now again, in rule of thumb doesn't mean you use smart money concepts or you believe in market manipulations, you follow the footsteps of the composite man, the big banks, or whatever. I don't care. The rule of thumb is the higher the RR, the lower the win rate, no matter what. So for example, in basic terms, for RR, let's just say we have a fixed RR, a 4 RR. Now roughly that gives you maybe 40% win rate. And again, if you use a 2-to-1 2 RR take profit, then again our win rate would increase, but our profitability would decrease, since it's now a 2 RR, meaning you risked once, your reward is 2. Unlike the earlier one, you risked once, you risked 1%, now you gain 4% if you risked 1%. Now if you go back to the 2 RR, then again it would increase our win rate but decrease profitability. So this really depends on what type of trader you are, what is your characteristics, what you like. Do you prefer having a high win rate? Do you stand a chance on looking at your PNL, seeing multiple reds, and just waiting for that one huge winner to cover up all those losses? Because again, you're using high RR. Let's just say you're using 20 RR. Okay, this is hindsight, but again, if you backtest what I'm teaching, or the concepts I'm not really teaching because it's not mine, but on the concepts I am teaching on a beginner level, or in other words, this is how I see the concept, and this is how I would teach the concept to other people. Because again, some people will not get what other mentors will say or other teachers will say. That's why they look for other mentors or teacher or YouTube channels or whatever. because it doesn't fit their personality on how they teach, or in basic terms, how their mentors or other mentors use this concept in their strategy. Now, again, let's go back to our trailing stop. Now, what you can do as an aggressive trailing on an aggressive term, because again, we have a POI. Now we're expecting price to push to the upside, to continue higher to a new higher high on larger time frames. So let's mark this up as blue. Now again, what you can do if we have confirmation here, breaks on the aggressive side, you can use, what you can do is trail your stops below, oops, oh it's red, my bad, below these structural points over here. That's the aggressive side, because again, you are trailing your stop according to the structure on lower time frame. And again, doesn't mean the structure on the lower time frame. If you haven't seen my structure, mastering market structure, whatever, check it out. I think it's a very good content on my channel. And again, if you base, let's say we see a break of structure here, now you trail your stop here, we see a break of structure here, trail your stop, same again, same. Doesn't mean on lower time frames it's forming a bullish trend to the upside. It's not gonna push down to even lower zones. What it means is, if price on larger time frames is doing this, oh let's just larger time frame doing this. Now obviously on lower time frames, price be doing this. Currently we're in an uptrend, now we're in a downtrend. Uptrend again, now we're in a downtrend again. Then continuing on more price. But basically, if you use this, the aggressive type of trailing your stop, again, what you could encounter is, when you zoom out, you see you're expecting the larger time frame to do a pullback. See this orange line? We're expecting, let's say we're at this current point. Obviously, we're expecting a pullback because price will obviously do a pullback at some point. So if you're expecting a pullback, then obviously if you're trailing your stop aggressively, you're obviously going to get stopped out, specifically on this lower time frame, because again, doesn't mean on lower time frames you're seeing a bullish trend. Doesn't mean it's gonna form, doesn't mean it will keep going up. Again, we have to rely on the larger time frame. What do we see larger time frame doing? We're expecting higher highs, higher low, higher high, and higher low. Meaning we're expecting a higher low. Then what does a higher low do? We need a retracement to the downside. Now this is where you could get stopped out. But again, if you trail your stop aggressively, there are more chances. It's less profitability, but at the same time, it's less chances of you getting stopped out. Let's just say we entered here. Your entry was there. It's less likely for you to get stopped out on your stop loss, or on your exit point, the losing point, or getting stopped out on break even, because again, you're trailing aggressively. So it's there's pros and cons and everything, so you have to choose. Either you want less profitability, but at the same time less chances of you hitting break even and hitting your stopping point. Now this is the aggressive side. Again, you have to choose backtest so you can see more. Now we can go on the conservative side. Now as you can see, let's go back on this drawing. Let's just say we entered on, say price is doing this. Let's extend this. Again, the blue line is the larger time frame structure, so expecting price to push to the upside. The orange line is the lower time frame structure. As you can see, if you entered on the test over there, then you trail your stop aggressively according to this lower time frame structure. Say after the structural break over here, you move your stop here. After the structural break over here, you move your stop here, move your stop here, move your stop here, move your stop here. Now, in short, you've secured profits, less profits though, because again, we're expecting price to shift from this point to up to the upside, then you're missing out on a larger RR target. But again, at the same time, price could also stop you out. So this is a thing between that what strategy fits you, or what type of trailing stops, either the aggressive or conservative kind of stops that fits your strategy or your personality. And again, since we're expecting another lower high, I mean a higher low and higher high, just a basic pullback of this larger time frame structure, then if price shifts on lower time frames, creating a bearish move, then you will get stopped out immediately. Obviously, because we're expecting a higher low than a higher high, basically just following this blue line over here, the larger time frame structure. And again, it's pros and cons. You've secured the profits at the lesser profits, of course, because you're getting stopped out on lesser RR, but at the same time, lesser chances of you hitting break even, lesser chances of you hitting your stop level. I mean the stop loss where you lose money. Now let's go to the conservative side. Now again, we have a POI over here. Let's just imagine this is the larger time frame structure. Lower lows, lower high, lower low, lower high. Now we're expecting a shift from here. Then we look for confirmations. Then we'll enter based on smaller time frame market structure breaks. Then we're expecting price to push to the upside. Now what a conservative trailing stop would do is you trail your stop according to the larger time frame structure. Now again, unlike the aggressive one, where the aggressive one trails within the lower time frame structure from the lows, I mean the higher lows, higher lows, higher lows, higher lows. This one, you trail it according to the larger time frame structure. Now let's say we entered here. Let's just say we see a market break over there, then our TP is way up there. Now what you can do is, after price, let me just remove this for a bit. Price went low, we see confirmation. Now price broke the structural point here. Doesn't mean it breaks structural point we should move our stop immediately, either to trail in profit or either in break even or the entry point, because price, again, as you can see, at some point I'll show an explanation or a real example later. But again, let's say if we entered within here, within the price, there's possibly an order block there. Now what price could basically do is mitigate that OB and continue to the upside. Now, if you trailed your stop according to this break of structure here, then it's possible that you'll get stopped out. That happened to me multiple times. I missed multiple trades, great trades, an 80RR and a 50RR, 40RR, another 50RR, because of this simple mistake. Basically, not looking on the overall structure, because again, structure could do a retracement to the downside, tap on an OB over here, mitigate it, then push to the upside. Now what I would do is, currently at this point, if price, give me 1 second, oops, oh my word, price broke the structural point here, I still wouldn't move my stop there, because price, again, I waited either to retrace at the 50% of this move over here, either from this area here and push to the upside, or go down. I waited to go down, mitigate some OVs over here, and continue to the upside. As soon as price breaks this structural point over here, then I would move my stop to either break even or the previous higher low of the market structure. What I mean, the previous higher low of the market structure is, price does that, then I would move my stop to here. Not directly pinpoint at here, at the exact low, but below that a little bit. The reason why I move below, just the below of it a little bit, is because price might go down, liquidate a little bit of this low, then push to the upside. Again, it also could not do that. Let's just say we have an OB at that swing point over here. Price also could just tap on that OB over there, then continue to the upside. Then again, I can trail my stop. Then I trail my stop to this low point over here. The reason why we would follow the larger time frame or the conservative type of trailing your stop is following the larger time frame structure is if price either breaks this point over here, let's just say price breaks this previous higher low, then either this is a liquidity grab or a push order flow shift to the downside. Now we can either see price continuing to the downside, basically shifting from a bearish order flow from bullish, breaking structure over here, no bearish, breaking structure over here. It's either liquidity grab or a order flow shift to the downside. Now again, if we're expecting, if we bought from here, because we're expecting price to push to the upside, then price should have no reason, either if it's a liquidity grab, but in simple terms, it should have no reason for price to go below from this point. Because again, we're expecting price to continue to the upside. Now, if price breaks lower to that point, now it's probably shifting to the downside. That's why we put our stops here, because let's just say it's not a liquidity grab. Let's just say it's an order flow shift. Then we could be protected from that order flow shift to the downside and not losing. Let's just say we risk 1%, not losing the full 1%, or maybe just having tiny bits of profit if we trailed our stop within this line. Now to a real world example, again, what we can see is the order flow is currently to the downside. As you can see, lower low, lower high, lower low, possibly a lower high and a continuation to the downside. Then we look for POIs. You have a refined 15-minute single POI over here, or order blocks, followed by an imbalance, followed by a break of structure, also another impulsive move to the downside to break the structural point over there. Now what do we see? We wait for confirmation. As you can see, price tapped into it. Let's just go on the 1 minute. As you can see, price made a beautiful distribution over here, buying climax, AR, either this could be an ST or a UT, whatever, then a UTAD, breaks of structure, then either you could enter from this point over here or a more refined one over there. But the main point is we're using trailing stop. Let's just say we entered from that point over there. Oops, just clear this drawings out. Let's say we entered from this overall OP over here. On the 5 minute, it's a single OB on the 5 minute. But again, this is just hindsight. This is just an example. Again, if you don't believe me, you can backtest it. Again, you shouldn't rely on someone from YouTube or a mentor. You paid for a mentorship to do the backtesting for you. Of course, you have to gain confidence on your strategy. At the same time, gain some experience on the market, either backtesting or forward testing. Let's say we targeted this previous low over here. This lower low over here, because again, we're expecting price to push to the downside. Lower low, lower high, lower low, lower high. Now we're expecting another lower low. Why are we targeting this? It's more probabilistic since we're in a bearish trend overall. Now again, let's just play this out. As you can see, a beautiful example for a aggressive versus conservative stops. Now again, let's just start on the conservative. Again, what did I say on conservative? We move our trailing stop after price on the larger time frame makes a pullback. As you can see, we have an order block over here. What price did is tap on that order block over there, then continue to push to the downside. After it tapped in, we can then move our stop here, roughly 50% of our overall stop, meaning we could lose, instead of the 100%, now we can lose the 50%. Lesser is better. Stick to your rules, but that's the conservative side. Now let's just say price went above again, tap to this OB over here, and push lower to break the structural point. Then we can move our stop to that point over there. Now on the aggressive side, again on the aggressive side, we move our stops according to the structural moves on lower time frames. As you can see, what does the lower time frame do? Lower low, lower high, lower low, lower high, breaks of structure. Now we can trail our stop to this point over here, locking us in roughly 2.5 RR. lower low again, lower high, lower low, moving our stop again, lower high, lower low, lower high. As soon as price broke this point over here, we can then move our stop to there. Now we're expecting another lower low. Oops, my bad. If price broke the structural point over here, then we move our stop there. Price broke the structural point over here, then we move our stop there, locking us in roughly 3.5 RR. So we locked in 3.5 RR, but again, as you can see, lower low, lower high. We're expecting another pullback near the lower high. Did it go above? Oh, it didn't go above, luckily. So pull back to the lower high. Now we're expecting a break to the lower downside before we can move our stop to here. But as you can see, price broke that point, meaning it stopped you out at 3.5 RR. Again, this is the point where I said at the beginning, it's a lesser chance for you to hit break even or hit your stop, the full 100% stop loss or the 100% loss if you trail aggressively. But again, you could also lose or have less profitability because again, what if price went lower to the downside or on more lower points? Now again, you have to choose aggressive. It depends if you really want to defend your P&L or your capital, or you can choose the conservative side, wait for the larger structural shifts to bring it to the downside. As you can see, price broke it beautifully. As you can see, made a pullback over there. Now what we could do is wait for a structural break at this point. Over here, structural break. Now we can move our stop to this point. Now we can wait. As you can see, TP hit. Again, this is hindsight. Backtest it yourself. Is again, you could see that was a 11 RR, I think. 11 RR. Let's just say 12 RR. On the conservative side and on the aggressive side is a 3.5 RR win. And again, as I said, if you go for a conservative side or a conservative style, again, price could tap you out immediately, meaning higher profitability, but more chances of you hitting PE and SL. On the aggressive side, lower profitability, but lesser chances of you hitting PE and SL. And it's up to you on what fits your strategy, but that's it. Thanks for watching.